Hello students, welcome to my class. This is Professor Vincent Usaya and this is part 2 of chapter 8 presentation, audit sampling. In part 1, we left off by talking about sampling risk and talking about two types of sampling risk, type 1 and type 2. Still talking about sampling risk, here are three important factors in determining sample size. Number 1, the desired level of assurance in the results, or what we call confidence level. Number 2, an acceptable defect rate or tolerable error. And number 3, the historical defect rate or expected rate. Now, let's take a look at number 1, the desired level of assurance. So here is the confidence level or the confidence or the assurance the auditor desire in conducting this sampling. Number 2, acceptable defect rate. So this is the rate or this represents the exception rate that the auditor will permit in the population and still be willing to accept the control as being effective or accept the account balance as not materially misstated. So we call that the acceptable defect rate. Now we call it defect rate in chapter 8 because we are talking about test of controls. In other words, the percentage or the rate of deviate of the controls working or not working. Now in chapter 9, we call it tolerable misstatement. In other words, how much misstatement are we willing to accept in a particular account balance or classes of transactions. Now let's take a look at number 3, the historical defect rate or the expected rate. So based on our knowledge about this client, about their system, about our history, about the previous audit, we expect that a percentage of the controls might not work. Again, it is not a perfect world. For example, if you have an apple farm and you are able to harvest 10,000 apples in a year, it is not likely that all of them will be good. You are going to have some defective or some rotten apples among the entire population. So here we are talking about the historical defect rate or what we expect ordinarily. So these are the three important factors we have to take into consideration in determining sample size. So moving along, let's talk about confidence level here. We say confidence level is the complement of sampling risk. So the question is, what is the definition of a complement? Of course, as you know, a complement is a thing that completes or brings about perfection. So for example, if you have 80% of something, you need 20% to complete it to make 100%, or 60%, 40%. So that is complement. It brings about a completion. So here we are saying that confidence level is the complement of sampling risk. So what does that mean? Here we say that the auditor may set sampling risk for a particular sampling application at 5%, which results in a confidence level of 95%. So in other words, if the auditor wants to have a 95% confidence level using sampling or performing this particular application, then the auditor is allowing for 5% sampling risk. Now, let me go ahead and give you another example that probably will illustrate this better. If the auditor desires to have 100% confidence level in this application, then the sampling risk has to be 0. If sampling risk is 0, that means the auditor is not taking any risk whatsoever. Then what is the implication of that? Then in such circumstance, the auditor has to examine or test every transaction in that particular population. In actuality, that is no longer a sampling. But I'm using that extreme example to illustrate or to get this point across in terms of how confidence level is the complement of sampling risk. So let's assume that the auditor decides to or desire 100% confident level, then the sampling risk is 0. So what is the implication of that? Like we said, the auditor has to test every item in the population. Again, as we know, that is very time consuming and it is extremely cost prohibitive. You know, it was very costly. So, so like we indicated, whenever the auditor is in a situation or circumstance whereby he is able to test less than 100% of the items in a population, he applies audit sampling. Now, moving along, let's take a look at the tolerable and expected error. We said that once the desired confidence level is established, the sample size is determined largely by how much the tolerable error exceeds expected error. So hold on to that thought. Let's take a look at another definition here, precision. We said that precision at the planning stage of an audit sampling is the difference between the expected and tolerable deviation rate. Precision measures, for those of you that have taken business stats, we said that precision is the statisticians use that term precision. We said that it measures the closeness between the sample estimates and the entire population characteristics. We don't call it precision in audit, rather we call it allowance for sampling risk. That is what the audit standards call it. So now, at the end of the day, what does this mean? When we say that the sample size is determined largely by how much the tolerable error exceeds expected error. What does that really mean? Let me go ahead and illustrate that by using some numbers. Let's assume that the tolerable error or deviation rate is 8% and the expected deviation rate or error, the tolerable deviation rate or error is 8%, the expected deviation rate or error is 2%. The difference between the tolerable error of 8% and the expected deviation rate of 2% will give you 6%. Now, the 6% is the allowance for sampling risk. So what does that mean here? Here we are saying that the auditor is willing to tolerate 8% deviation rate. That is what we are willing to tolerate as an auditor. We also know that the traditionally expected deviation rate is 2%. So the difference is 6%, and that is the allowance for sampling risk. Now, I know some of you might be thinking, Sam, what does that mean? Let us go ahead and illustrate this further. Let's assume that the tolerable deviation rate is 9% and the expected deviation rate is 8%. The difference of 1% will be the allowance for sampling risk. What is the implication of that? What is the implication of that? Take a look at this. If we are willing to tolerate 9% error and the expected deviation rate of error is 8% and the allowance for sampling risk is 1%, then guess what? What is the implication? The sample size, if we are looking at the allowance for sampling risk, that is all we are taking, all the sampling risk that we are taking, then the sample size has to be larger because there is smaller margin for error. So in other words, we are making a very small margin of error when the allowance for sampling risk is very low. Then the sample size has to be larger, and that will require us to do more work. So having said that, let's take a look at this again. We said that once the desired confidence level is established, the sample size is determined largely by how much the tolerable error exceeds expected error. Okay, so that is how the sample size is determined. So moving along, let's take a look at audit evidence, to sample or not to sample. So what are we talking about here? Here is the relationship between audit evidence types and audit sampling. So there are some situations that lead to a sampling. There are some situations that you really cannot apply a sampling. Here are some of the examples. Number one, inspection of tangible asset. Yes, audit sampling is commonly used. Inspection of records or documents like invoices, vouchers, so on and so forth. Yes. Reperformance. Yes. Take a look at the last one. Observation. When you are merely observing as an auditor while you are doing your work, that does not lead to sampling. So having said that, let's take a look at the additional expansion of this topic, to sample or not to sample. Inspection of tangible assets, yes, that situation leads to a sampling, because we can decide to take a sample of a lot of tangible assets in different locations and apply an audit application or audit procedure to it. So inspection of records or documents, yes, that also can lead to a sampling. Now, reperformance, of course, yes. Confirmation, yes. We can choose to confirm less than 100% of the items in an account balance. Now, let's take a look at testing all items with a particular characteristics. What are we talking about here? We said that when an account or class of transaction is made up of a few large items, the auditor may examine all the items in the account or class of transaction. So what are we talking about here? You have a particular account balance with $2 million. There are only 5 transactions that make up the $2 million. So auditor can just choose to examine the 5 items and I just examine everything that make up the $2 million. Now here's another situation. When a small number of large transactions make up a relatively large percent of an account or class of transactions, auditor typically would test all the transactions greater than a particular amount. So that's what I'm talking about here. We have 1,000 items or 1,000 transactions. And the 1,000 transactions make up $10 million. But guess what? 5 of the 1,000 transactions is 90% of the total account balance. Then we can just examine the 5 or 6 items and forget about the rest. So when a small number of large transactions make up a relatively large percent of an account balance, we can zero in on those and forget about testing the rest. So that will be the conclusion of part 2 of this presentation.